And welcome to LiveSquawk's Market Talk on Wednesday, the 28th of January, 2026. Today's episode previews the impending FOMC interest rate decision later on today. To be precise, the decision will be announced at 1400 Eastern Time, 1900 GMT. The press conference is scheduled for half an hour later and will be hosted by the Fed Chair, Jerome Powell. To help navigate through the expected announcement, I'm joined today by a market savvy expert and regular guest on the Market Talk, Joseph Choi, author of popular market blog, The Curve Advisor, and by Sam Cutler, portfolio manager at 333 Capital. He's an astute and well-read individual who knows his stuff on the markets. So a warm welcome to you both. Hello, Joe. Hello, Sam.
Hey, Joe. How are you guys?
Hi, well, thanks for having us on.
Oh, always good to have you guys on. Just before we get into it, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Before I come to you both on your thoughts, just a quick note here from some bank research on today's announcement. We have got a preview up on the website, LiveSquawk.com. If you want to go through the FOMC preview there, you can find it out on social media as well. But this is a JP Morgan note. It says FOMC meeting should be uneventful, easy call, which will welcome a change for the committee, which will be a welcome change for the committee. We and almost everyone else expect that the policy rate will be left on hold with a target range for the Fed funds rate of 3.5 to 3.75%. Governor Myron is likely to dissent again for further easing, and there's a risk that Governors Bowman and Waller could also dissent. There will be no new set of dots or economic forecasts, and the changes to the post-meeting statement are unlikely to offer material policy signals. At the press conference, we expect that Powell will indicate that policy is well positioned to address risks to either the Fed's mandates, and we think he'll avoid discussing the various political issues relating to the Fed. Before we started, I was just talking to Sam there, and we were saying that we feel like we've aged like nothing else over the last just week, 2 weeks or so, because of everything that's gone on, and we're still not at the end of January yet, but we'll get into that in a minute. Right, we'll start on today's, again, as JP Morgan calls it, uneventful meeting. Sam, I'm going to come to you first. What are your initial expectations for today?
Yeah, I mean, I'm pretty much on the same lines as you just spoke about there for JP Morgan. I'm really not expecting too much from this meeting. I mean, they just heaped like $40 billion a month into the ample reserves framework. You know, I think they're going to be comfortable. They're not going to be comfortable, sorry, to pre-commit to what they have in mind for the next decision, which is coming March 18th. I'm honestly, like personally, I'm leaning towards a little bit of a cut there. But hopefully, barring, you know, another government shutdown, we're going to have a ton of additional data and, you know, maybe some, you know, further developments on policy here. But I think the most relatively, I guess we'll call them minor things to watch are just going to be, you know, some of the statement tweaks, right? The statement upgrade may reference the economy, you know, expanded at, let's call it, you know, a more moderate pace to something stronger. Also curious if they're going to mention anything on that unemployment rate, just because of the major drop we had last time on some possible, you know, seasonal adjustment stuff. I think Powell's going to really just come across pretty neutral at the press conference. You know, on inflation, he's probably likely to repeat his view that inflation risks are going to just kind of be temporarily kind of over in the coming months. But I think that opinion is going to vary across the committee. On jobs, right? The deteriorating payrolls. I think here we're kind of pointing to a broader suite of data, and you know, I personally think the employment rate here, I don't think the jobs market is great, and I think it's going to continue to worsen a little bit. We're still seeing, you know, kind of the hiring freeze, but we're not really seeing the firing, as we've seen, you know, kind of claims continue to be, you know, relatively neutral. But I'm curious how long this is going to hold on for, and we can get into that later when we talk about, you know, kind of economic activity that we've seen so far. But I think one other just important point to note, I guess, on this is the voting status of the regional presidents for the Fed here rotates this meeting. So obviously, again, we're going to have some dissents, right? Moran's going to do so. Bowman's probably going to join him. And then maybe we're going to get a dissent from Waller as well this time. But, all in all, I don't think there's really too much going on here, right? Inflation at 2.8% year over year. The committee, I don't think the full committee is going to really have confidence that they won that battle. And I think eventually they're going to express more concern about the jobs market than they are at the moment.
Well put. Joe, from your perspective, how do you see today's event?
Yeah, I think the two of you covered it really well. I don't think, as with the other market participants, I'm not really expecting anything out of the meeting. And it would be weird for Powell to say more about Fed independence than he already has. I mean, I think he may repeat it, but since it's an ongoing litigation, I don't know that he's going to talk about it that much. And then as for the meeting itself, yeah, the only thing I'm really expecting are some statement changes. So they may say the unemployment stabilizing or growth is picking up or something, but I'm really not expecting anything from this meeting whatsoever. So, but I will be curious to see what the market reaction will be. And then, just for laughs, I'd be curious if Trump blows a gasket if the Fed holds. So, yeah, it's going to be a pretty quiet meeting.
Well, you mentioned Mr. T, you call him Mr. T, and his appearance at the World Economic Forum last week in Davos obviously caused a stir on the geopolitical front with comments on Greenland and everything else that went with that. That currently seems to have been all that unrest seems to have abated, and we kind of know where we are if we don't know where we are on the Greenland situation. Obviously, Iran is now the next thing, next hurdle for sort of investors and market participants to sort of just bear in mind at the moment. We've got an armada moving closer to the region, and we'll wait and see if he comes true on his words to make in his warnings to Iran, basically, and what they do in return. I want to move on then because, I want to talk about President Trump and just the fractures he's causing around the globe. And is he driving people towards China? This week, we've seen the UK Prime Minister. He's just landed in China with talks in Beijing with Xi. Is this impacting the way people view anymore, view the US? I'll start with you, Joe, because I know you've got some strong opinions on this anyway. And where do we go from an asset perspective? We'll come back to the strength of the US economy because that I want to bring it into link it with that at the moment. But just quickly on the geopolitical front, how much is he impacting your trading perspective at the moment?
Oh, well, I think we have to, take into account all the tail risks from some of the things he's doing. But I think because he's always prodding the commentary or the narrative, it's really hard to figure out what to take super seriously and what to take as a negotiating leverage. So, I was actually a little bit surprised that Trump came back so much on Greenland because he basically went in.
Are you
implying
taco? You're surprised about the taco trade?
Yeah. Well, the thing is, he went in implying he could use force, and then he came out of Davos with nothing, like absolutely nothing. Because whenever you hear him say they have a concept of a plan, that's basically Trump speak for nothing. And I guess what was surprising was just how quickly he did that 180 turn. And I guess I was thinking about it, and apparently he was polling worse on Greenland than he was on Epstein, if you can imagine that.
Wow.
So, uh, I mean, he's just gonna switch on a dime, and so while you do have to take into account tail risks of anything Trump does, yeah, because of the frequency with which he tacos, it makes for very difficult trading. That having been said, I think the markets are starting to ignore him to some extent because the volatility in interest rates has just been crazy low. So we'll get all these headlines and we'll have all these things happening. And like you and Sam were saying that there's been so much going on, but I mean, the daily moves in the interest rate markets have been negligible. And just kind of getting to something you were hinting at, has there been any long-term damage done to U.S. assets? I think that could have been a story for 2025, but it seems like the market participants don't really care that much anymore because equities are near all-time highs. And, like while you can argue that there has been a little bit of sell-off in the bond market, I think most foreigners have more equities than bonds. And so if equities are still going to do well, I don't know that there has been damage.
That's a good
And
point.
yeah, and so it makes me think that if nothing happened last year when all this craziness went on, then it seems to me that investors are willing to play the long game because Trump's only going to be in power for 3 more years. And I don't see how the next guy is going to be any worse than Trump. And if anything, it'll probably be much better. And so I think people are just trying to look past the short term and think more about the long term in their investments.
Yeah, but isn't the not knowing the real killer in any of this, where markets really like certainty and understand whatever that might be in whatever shape or form that takes? They know the uncertainty of Trump. They're less sure of the next person and how they pivot and everything else. Sam, you're a mid to long term investor. Does this create headaches for you?
I mean, it creates some headaches, but it really hasn't been anything substantial. I mean, markets for me, they've kind of performed as you'd expect them to be. I was
Bank
kind
of Canada holds policy rate at 2.25%, matching estimate.
sorry about that. Something
That's
just
all right.
popped.
This just shows
Yeah.
we're live today, and like Canada's left rates unchanged as expected. So as you were.
Yeah. So no, I don't think, I'm kind of with you on that. I expected, Trump to kind of pull back on this Greenland thing very quick. And, part of my brain went, okay, like Joe said there, is it, was he trying to play down kind of some of the Epstein file stuff? Who really knows there? But I kind of expected them to pull back on that relatively quick with not getting too much. The things on the Iran front, I find are a little more concerning than anything on the Greenland front, because I think there could actually be something a little more material developing over there. But all in all, man, like things have been tricky in the markets, but there hasn't really been a ton of movement. Like Joe was saying, rates markets have been, more or less relatively quiet to start the year. You had a big rotation in the equity markets, into kind of the small and mid caps to start the year. I mean, you look at the Russell 2000 and SWAT, it's up almost 8% for the year. I think, that's kind of has a pretty big drastic lead over the other indexes. So I don't think there hasn't been too much confusion here for me. I think, it just relates to, like Joe was saying, with the tail risks. When you're running a larger book, you have to look at all your positions and how they're correlated together and just make sure you have, at least a little bit of uncorrelated positions and some offsetting things. So if market turns, you're not panicking at once and your whole book's not, moving with the market if you're
Sure.
running some equity things.
So just been a bit more nimble in that sense.
Mm-hmm.
Trump mentioned in his rambling speech the other day, he 5.4% GDP growth for the US. In an environment like that, why would you urge further cuts? I mean, this is can you say oxymoron? Maybe I think you can. In what's coming out of the US at the moment, there is a resilience to the US consumer. There's a resilience to the US economy at the moment. And getting back to tonight's decision and future decisions, I know we're still pricing in 2 cuts for this year. Are rate cuts overpriced, underpriced from your perspective, Joe?
Oh, yeah. I think if you consider the tail risks, I think the rate cuts are underpriced for this year. Um, it- but one thing you mentioned that I wanted to focus on is that the growth has been very solid. So it seems that there are AI-related productivity gains and possibly some other productivity gains and some trade-related gains in the GDP. But one of the themes I've been talking about recently is that the GDP and employment seem to be going in opposite directions. So GDP has surged while employment has stagnated. And this is relevant because many of the Fed models that people use, both at the Fed and on the street, are dependent on some function of GDP or the output gap. And this is, so for example, the Taylor rule will use something related to GDP. And this is under the assumption that GDP and employment are strongly correlated. But it's possible that we could get hawkish signals from the models because of the growth in GDP in an environment where employment deteriorates. And the reason why this distinction is important is that the Fed's mandate is for employment and inflation. And so, at the end of the day, I think the Fed is probably going to look more at the employment than the GDP, in which case, what the models will tell us and what the Fed actually does may diverge. So I don't know this for certain. And I will be looking for clues in future Fed speak about how they look at this discrepancy. But I'm not sure that people should take so much comfort that GDP is strong that the Fed couldn't do something related to policy, even if GDP is as firm as it is.
Okay. Well, that leads me on to my next question, really. And just, sorry, Sam, do you have anything to come back on with that? Or you in agreement?
Yeah, no, I'm pretty much in agreement with Joe there. I think we spoke about this last time we talked that, I really expect the first half of this year that, data's going to surprise to the upside. The stimulus package ticking in, tax refunds going to be drivers. So, I firmly expect data to optically beat in Q1. But the main question for me is, late Q2, early Q3. Do we start to see some reversal in this led by, kind of a continuation of deterioration in employment?
Okay, interesting. Right. So we have on that front then, and we're looking at a dovish Fed, according to, or at least a more dovish curve. We do have a new Fed chair to be selected this year, and all the odds point to Ryder. Is it Ryder at the moment? I think we can say Ryder.
Yeah, I've heard it as reader, but I could be wrong.
No, that's fine. I'm trying to get a graphic up, which isn't working very successfully. He's currently at around 46% on for the Fed chair at the moment, with the next person, Kevin Walsh, at 27%. What do you make of this? The new front runner, I guess. He's always been a stalking horse, but he seems to have come to the more recently. Joe, what are your initial views on Reader?
Oh, well, I didn't like either of the other two candidates that had led, so I never thought, Hassett would be able to command any kind of respect from the rest of the FOMC, and Warsh seemed too Trump affiliated for him to get any respect, but. I've always liked Reader. I thought his views are very reasonable whenever he came on TV, and he seems like an amiable leader. And he's the least shill-like, so I think he's the guy who could get the most buy-in from the other FOMC members. So in that way, I think he's the most likely to be able to, nudge the rest of the Fed into lower rates. So I'm not saying that the rest of the Fed uh, would be amenable to lower rates. I mean, it really depends on the data, but I think he might be the most persuasive of the, three leaders that we've had so far. And then I think, eh, and I think just him like giving up like 99% of his salary to come to the Fed, I think would command a little respect.
But in your blog,
And
you said, why would he want the job? He's losing 99% of his pay. He would take most of the blame if the economy was to underperform, and talk to Trump on a. He'd have to talk to the president on a regular basis. And there was a Bloomberg piece that said Rick Ryder's readers donations to MAGA rivals test Trump's Fed chair demands. So he's a more complex character to have as the Fed chair, I guess, than maybe some of the other candidates or potential nominees out there. But sorry, I cut across you, Joe.
oh yeah, so I guess the way I'm looking at Reader in the short term is that previously we had Warsh leading, and I think that caused the markets to sell off a little bit. And I think if Reader got in, that might cause us to rally a little bit. The other thing about Reader is he talks a lot about home affordability, and he's not a consensus policy person. And so this is kind of a tail risk, but I think he's also the most likely to be able to talk to the members about somehow monetizing the debt or lowering mortgage rates or doing some other thing related to Fed policy that maybe isn't in the mandate, because he is an outsider, and I'm guessing he's probably also an out of the box thinker. And so that's something that I'm looking for clues on. But I'm not saying this is what he's going to do. I'm just saying,
Sure.
I think this possibility exists.
Okay. Sam?
Yeah, no, I think Joe covered that extremely well. I agree with him on a lot of topics there. I do think, it seemed to be a pretty drastic switch because if I'm not mistaken, Reader was priced down extremely low if you're looking at kind of those implied odds. And after the meetings in Davos there, it seemed like he really started to accelerate. So like Joe was saying, with his focus on home ownership affordability, that could be one of the large drivers for Trump right now that's kind of pushing him in that favor. I think that's really the the only thing I can add on that front. I don't really have too much to add on him. And again, I think I don't think it's one person that has the ability to drive all these interest rate decisions, right? It's a committee that has to agree on things. Like Joe was saying, I do think Raider there could be the best bet out of, let's call it, the top three that we had. If I had to vote for someone, it would be for him to take the position.
Fair enough. And there's something that I think, Joe, you've mentioned that, you said that before. This is a committee. It's not based on one person. Really, he just guides the narrative, I guess. We're coming to the end of the episode, so I want to bring it back to the Fed and today's decision and the press conference, because I think, obviously, with the decision, a fairly academic affair, people will want to look at the press conference for messaging. And like you've both alluded to, you don't think we'll see anything particularly leading from Powell, and he's no doubt going to be asked on the political front and everything else. And I know, Joe, you've mentioned that one of the funny things would be if he stayed on as a governor, even when his term as Fed chair were to end. Again, he's not going to be drawn on that today, even if he is asked. So looking at the press conference then and what the best case scenario, what you'd hope for, I've got a note from Bank of America Merrill Lynch here. They said market pricing has created room for a dovish surprise. More substantively on the policy outlook, we expect Powell to remain strongly data dependent and emphasize a meeting by meeting approach. But we think risks are skewed towards a dovish surprise simply because markets are pricing less than 10 basis points of cuts cumulatively over Powell's last two meetings as Fed chair, which is March and April. We'll be focusing on the following aspects: the labour market. Markets will be sensitive to the extent to which Powell leans into the decline in the unemployment rate in December, or downplays it as just a single month's worth of data. On inflation, the market response will depend on how much Powell emphasizes PCE tracking, which should be around 3% annually for December, versus continued housing disinflation and the fact that tariff-driven inflation has been less than expected. And finally, investors should watch Powell for comments on the neutral rate. On the neutral rate, Joe, I think we discussed it a while back now, the neutral rate there. Do you think, what's any framework around that neutral rate and how close we are to it potentially?
Oh, just from the dots, I don't think the neutral rate has really changed much,
Right.
For the better part of, I want to say, over a year. The main thing I'm going to be looking for is in his tone is to what extent, he seems more weighed by the employment than the GDP. Um, because, at the end of the day, I want to get a sense as to what the Fed's reaction function is going to be based on. Because there seem to be two narratives in the market. One is that Powell is going to defend Fed independence. And so the Fed is going to lean towards not doing what Trump wants, which is easing. And so I think that's why the next three meetings look very underpriced, considering we don't know how the data is going to turn out. Because I think there are only like 8 basis points of eases priced into the next three meetings. And it's not as if the employment has been solid. I mean, I think it has stopped bleeding, but at the end of the day, it's still bleeding, meaning, it's averaged only like 12,000 payrolls a month for the last 8 months. And then we haven't even factored in the QCEW, which means we probably lost like 50,000 jobs a month for 8 months. And so whether we look at the Fed narrative or, Powell, brings us back and makes us focus on the labor data.
Okay, fair enough. Sam?
Yeah, I mean, I hold a pretty similar opinion. I mean, my view of the real neutral rate kind of sits in that 50 to 75 basis point range. So if you assume,
Okay.
Eventually underlying inflation settles around 2.5%, you're going to get the Fed funds rate down to, 2.75, 3%. And I think that's more than likely to happen by the end of this year.
Okay, fair enough. Powell did say that, and this was at the December meeting, that we are within a range of plausible estimates of neutral. And Bank of America's interpretation was that Powell still thought policy was modestly restrictive, but was trying to reflect the range of views, particularly the more hawkish ones on the committee. Any change in his language around neutral or a stronger lean into the productivity story would be noteworthy, they say. Okay, we're now at the end of the episode, so I'd like to thank you both for participating today. Thank you very much for that. Just a quick reminder then as to when everything is. You got the FOMC announcement at 1400 Eastern time. That's 1900 GMT, and then 30 minutes later we'll have a press conference from Powell. So really focus will likely be on the statement and any changes to forward guidance, minimal as it may be, and thereafter what Powell has to say in terms of messaging and forward guidance in that respect. So join us at LiveSquawk.com. Take out a trial if you want to listen in live to that event today. If you've missed the start of today's episode, this will be on the socials from now, I guess. And you can to listen back on it on podcasts as well, if you want to pick out any snippets from what my two guests have had to say on the matter. Thank you both again then for today, and happy FOMC day to you both.
Yeah, you guys as well. Always great to talk to you both.
Yeah, thanks for having us on.
Brilliant. And as I said, go log into LiveSquawk.com if you have a membership and listening to tonight's event. Thank you very much for listening, guys.